Hi everyone, this is Dimitri Pragmatic with MarketChameleon.com. I wanted to share a quick scan with you using the credit put spread screener. A question I get frequently is, there's a two-part question. How do you set a target price? If you're going to hold a credit put spread from today to expiration, how do you set a target price, a stock target price? And based on that target price, the second question is, how do you know which strikes should you sell and should you buy to get the best return on the credit spread? So that's what we're going to do, is go over an example. There's no one right way to do it. I'm just showing you one way to do it and one idea. And before we get into the target price and which strikes, I like to first set a few filters. And one of the first things I do is look for credit put spreads with positive theoretical edge, meaning that the market price we're selling the credit put spread is above a long-term theoretical value, giving us a theoretical edge. So here I'm going to set the theoretical edge above 10%, meaning that the market price that we're going to sell it at is at least 10% or higher than the long-term theoretical value, giving us an edge. The next thing I'm going to do is expand the number of entries to any expiration that expires within the next 30 days. So now we're going to repopulate our items, and now we have over 9,000 items looking for any credit put spread with any expirations, any expiration that, as long as it expires within the next 30 days. Then another thing, when you're doing a credit put spread, your outlook is bullish, right? You have a bullish outlook, and you probably want to check any type of news or any kind of event that could impact the price negatively. And you could do that research. And one way, another thing that I like to set to cheat a little bit is I look for stocks that are currently in an uptrend. So I'm going to go over here, underline stock ideas, and I'm going to look for stocks that are in an uptrend, meaning all the moving averages in the recent history have been pointing upwards. So the idea there is that if there's any type of negative news impacting the stock, then it wouldn't be in an uptrend. So now that we have these initial filters, let's go look for possible ways to set a target price to expiration, and then look for what are the best credit put spreads to do based on that target price. And the first example in the show is a seasonality. And the idea here is you already did your research and you look at, you filtered out stocks that you feel are strong. The market is strong. Let's set a target price. And the seasonality looks statistically, what is likely to happen between now and expiration. And here in this example, today's July 19th. This expiration is August 2nd. So how did Microsoft perform in the previous 12 years? We're using 12 years of observations here between these dates. And we're looking for strong seasonality, so positive seasonality, because we're doing a bullish credit put spread. So let's first filter that out, and we're going to look for stocks that had strong seasonality. And I'm going to look for above 70% win rate, meaning over 70% of the time, or more historically, between now and expiration, during that hold period, the stock was up or positive more than 70% of the time. So we could see here it started filtering these out for us. And let's also look for a positive return over that period. And let's set a minimum. I'm just going to set a minimum of 1%, at least 1% of the average of all the returns of all these 12 observations, or at least 1% or higher. And I'm going to set a median return above 1%, meaning that at least half the returns were 1% or higher. So now that we filtered out all these stocks, and right here it's right now sorted by highest market cap, but we can resort that by any of these columns. I'm just doing this by theoretical edge right now, and then we see a list of different stocks. Since we filtered out now strong seasonality, and we have a few choices here, and let's look at a possible target. Now we could target the average seasonal move. We could target the average up move, average down move, but let's just look at the for example, here, the average move. And I'm going to go look at the strategy payoffs. So these are the payoffs of each of these credit put spreads at expiration based on, where the stock might land. And in this example, here's if the average seasonal move. I'm going to sort this, and we're going to look for, in this example right here, you would lose 100% of your risk, meaning that target over here, if you did these strikes, the 92.5, 91 for the July 19th, it wouldn't move far enough, so you would lose 100% of your risk. So let's just resort that by the highest. And here, this is where you're getting the best returns based on a target of the average seasonal move. So here in QQQ, if you did for the July 19th, if you sold this strike, bought this strike, and the stock increased by the average seasonal move by expiration, then this is the return that you will get. So that's what these columns are. You could also target, for example, the average up move. Just isolate all the up moves, and on average, when it's up, what is the average up move? So you could sort it by here, or we could even set a minimum. So if the average seasonal move, if that's where the stock lands at expiration, we need at least, let's say, a 25% return. So that's what this is going to do. So all these are now sorted by at least a 25% return or more if the stock replicates its historical average seasonal up move. And that's how you would set target prices, and then based on those target prices, you could go in there and see, well, which combination of options would return me the best return, given all these parameters. Hope you liked the video, and see you guys next time. Bye.